For nearly a century, one phrase has haunted the halls of Wall Street: sell in May and go away. It refers to the historical underperformance of stocks during the 6-month period from May to October. But as we sit in mid-2026, something is fundamentally broken in this seasonal narrative. Bitcoin is hovering steadily above $82,000, and the traditional summer lull has been replaced by a high-frequency digital pulse. The old guard is waiting for a crash that isn't coming, while a new class of institutional capital is quietly building a floor that the retail market hasn't yet accounted for. Today, we deconstruct the fallacy of the summer sell-off and reveal the hidden liquidity pipeline keeping the... To understand why sell in May is failing, we must understand why it existed. Originally rooted in the London stock market, investors would flee the city's heat for their country estates, leading to low volume and stagnation. This seasonal pattern persisted through the industrial age. However, in a 2026 global economy powered by 24/7 decentralized finance and automated ETF rebalancing, the concept of summer vacation for capital is an anachronism. Data shows that since the mass adoption of spot Bitcoin ETFs, the correlation between summer months and negative returns has decoupled by nearly 40%. Look at the charts. In previous cycles, a price point like $82,000 would have triggered a massive wave of profit-taking heading into Q2. But in the current macro landscape, this isn't a ceiling, it's the new baseline. We are seeing a structural shift where Bitcoin is being treated not as a speculative seasonal asset, but as a core component of the global tech infrastructure. The influx of institutional sticky capital means that the sell-side liquidity simply isn't there to drive the prices down to traditional summer lows. The cycle has mutated. The 1.45-minute mark brings us to the most critical factor, the liquidity pipeline. In 2026, the pipes of the financial system have been re-engineered. We are no longer just looking at retail FOMO. BlackRock, Fidelity, and state-level sovereign wealth funds have integrated digital assets into their automated buy-side algorithms. These programs don't take summer breaks. Analysis of the latest 13F filings reveals a staggering increase in mid-year accumulation by pension funds, acting as a massive net to catch any minor retracements. This is the institutional floor that is breaking the historical sell-in-May pattern. Why is this happening now? Because the line between tech stocks and crypto has vanished. The massive investment in AI compute power and decentralized physical infrastructure, or DePIN, has created a synergistic demand. As companies like NVIDIA and Microsoft expand their data center footprints, the underlying blockchain protocols used for verification and settlement are seeing record mid-year usage. This isn't just about trading, it's about the literal plumbing of the 2026 internet. When utility meets capital, seasonality takes a backseat to growth. Beyond the ETFs, we must look at the M2 money supply. Central banks in 2026 have shifted to a stealth easing posture to manage debt loads. This constant injection of liquidity into the system finds its way into the most liquid, high-performing assets first. When you compare the sell-in-many years of the 1990s to today, the sheer volume of global currency in circulation is incomparable. We are in a regime of permanent bid for scarce assets. If you sell in May, you aren't avoiding a dip. You're likely being priced out of the next leg up. At 4 minutes and 30 seconds, we enter the volatility trap. This is where retail investors get crushed. It's vital to distinguish between a trend reversal and a natural mid-year consolidation. Consolidation is the market digesting gains. In 2026, we see this as lateral movement between $80,000 and $85,000. To the untrained eye, it looks like momentum is dying. To the institutional algorithm, it's a reaccumulation zone. Selling here is essentially handing your position over to a billionaire's robot for a discount. Market makers use this sell-in-May myth as a psychological weapon. By painting the tape with small, aggressive sell orders during low-volume holiday weekends, they trigger the stop losses of retail traders who are conditioned to expect a summer dip. This creates a feedback loop of forced liquidations. If you see the price dip 3% on a Sunday in June, ask yourself, has the fundamental thesis changed, or is this just a hunter looking for liquidity? In 2026, the answer is almost always the latter. The blockchain doesn't lie. While news headlines may scream about a summer slowdown, On-chain metrics like exchange outflow and mean coin age tell a different story. In the current 2026 window, we are seeing record amounts of Bitcoin moving into cold storage. This indicates that the largest holders have no intention of selling. When supply on exchanges drops while institutional ETF demand stays constant, the result is a supply shock. This is the coiled spring effect that typically explodes in late August, catching the sell in May crowd off guard.
So how do you play the summer of 2026? Instead of exiting the market, the professional playbook involves defensive diversification. This means rotating a portion of speculative gains into high-yield real-world assets, RWAs, and decentralized credit markets. By capturing 8 to 12% yields on tokenized treasury bills during the consolidation phase, you are outperforming the cash holders while maintaining your exposure to the primary bull trend. This is how you stay in the game without sweating the daily volatility.
For the capital you need to keep liquid, 2026 offers sophisticated stablecoin parking. We are seeing the rise of yield-bearing stables backed by over-collateralized on-chain debt. This acts as your dry powder. If a genuine macro shock occurs, you aren't stuck in a falling asset, but you aren't sitting in a depreciating fiat currency either. The goal of the summer is capital preservation and readiness. Position yourself so that a dip is an opportunity, not a catastrophe. The smart money isn't away in May, they are repositioning for the Q4 surge. As we look toward the final months of 2026, the sell in May fallacy will likely be the reason many retail investors miss the final leg of this super cycle. The combination of ETF demand, AI infrastructure integration, and global liquidity is a triple threat to the old seasonal rules. History is a teacher, but it is not a prophet. In a world of digital acceleration, those who wait for the patterns of the past are left behind by the realities of the future. Stay positioned, stay informed, and don't let a 100-year-old myth dictate your financial future.